Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm Kristen Myers, editor-in-chief here at ETF.com, and I'm joined in today's episode by Wealth Management editor Jeff Benjamin, research lead Ken Tooney, senior analyst Sumeet Roy, and editor Ron Day. Now, we've got a full lineup today, including a conversation with Alps ETF chief strategist Paul Baiocchi. But before we get to that conversation, I first want to talk about a pretty new and exciting franchise that we've launched here at ETF.com, which is called Leaders. And it's actually a list, and not just a list, truly a community of the top 100 financial advisors and the top 50 advisory firms that we've identified for folks out there that are looking for essentially financial advisors or for firms that are going to be utilizing ETFs in their portfolio. So it's something I'm super excited to chat about. And I'm really excited to have both Jeff and Kent here. Jeff talks to financial advisors all the time. Kent himself is a financial advisor. So I'm really super excited that we've launched this new community, guys.
Yeah, it's I think it's going to be helpful to investors in general. I know it's helpful to the advisors on the list because they're now getting a higher profile on our site at ETF.com, and it's featured and showcased, and the firms and the advisors. And to be clear, it's not necessarily the crossover. If you see a firm there, it doesn't necessarily mean that one of their advisors is on the advisor leaders list. But it's interactive, it's searchable. You can screen if you're looking for say an advisor, for example, that has a lot of assets or not a lot of assets, or has an average, it talks about their account minimum. It shows their focus on ETFs or how much ETFs they're managing. To be clear, every advisor on this list has, I think, at least 40% of their portfolio in ETFs, their client portfolios. But it's a lot of information here, and I think it will be helpful to investors.
No question, the list is valuable not just to the advisors who are on it, but also our readers who are investors. And I'm sure everyone listening realizes this, but maybe just mention the impact of ETFs on the industry. I'm an investor in ETFs, but also an advisor that uses almost exclusively ETFs for my clients. But I mean, how much is the industry? What's the value of it, U.S. assets? Isn't it over $11 trillion? I mean, it's growing so fast. No question that not only are beginning investors are using it, intermediate, advanced investors, but also advisors in their asset base. It's more and more becoming the case where investors need their advisor to have a good understanding of ETFs, and that's kind of a little intro I was going to give on the value of this list.
Yeah, I'm actually glad you mentioned that. It comes at a pretty interesting time. I mean, we've crossed the $900 billion threshold of inflows into ETFs. We're targeting 1 trillion, which would be a record high in 2024 for inflows into ETFs. And I mean, listen, we did our own investor survey. We talked about that in a previous episode. If you haven't heard it, go check that out. But we did a global investor survey where we pretty much asked both financial advisors and also retail investors, hey, do you like ETFs? They almost all categorically said yes. And do you want to invest more in ETFs? And over 60% of them, both retail investors and financial advisors, said yes, they would be adding ETFs to their portfolios in the future. So to your point, Kent, it is super important if you are someone who is looking for a financial advisor, even wants to change their financial advisor. It's important to know if the finance professional that you're relying on actually has a grasp or utilizes ETFs in their client portfolio. So this is why this list is so important. Before we talk about it a little bit more, I kind of want to break down a little bit of who's on the list and what was some of the criteria that was being considered. So again, we have 100 top financial advisors. They are not ranked, folks. If you're checking out this list, there is no number one person and number 100 person. It's just 100 folks that have made this list, 100 advisors and 50 firms. Now, one of the top criteria to being on the list was actually percentage of ETFs that is being used in client portfolios. Jeff mentioned a statistic about it being at least 40%. I think the number actually might be a little bit higher. I would have to go and double check, but it was a requirement that they had to utilize ETFs, and they had to utilize a pretty sizable percentage of ETFs in client portfolios. But we also looked at firm size. We looked at client retention on this list. AUM growth was also considered on the list, as well as total AUM. And so this list we really wanted to make sure could appeal to a lot of investors that might be looking for an advisor or for a firm to really handle their money. I should also say that everyone on the list has at least passed a first round vetting. They have had their credentials checked or double checked through the SEC. However, if you are looking at this list, consider that a first pass. Do your own research. Make sure you go again and check their credentials and their background and the tests that they passed, and have conversations with them to see if they are a right fit for you, because I think that's super important. But I also want to make sure that we put that out there, that this is, again, is a great starting point for you to find an advisor, not necessarily your end point. I'm not sure if Ken has thoughts on that in terms of finding an advisor and what people should be looking at.
Absolutely. Yeah. I mean, I was going to add another little anecdote, which is, ETFs are growing so fast. And you just mentioned, 900 billion this year. But I've been investing in ETFs since the very beginning. My first client that I remember buying SPY around 20 years ago. And they've grown so much since then. But I'm at the point now where I've actually picked up clients because their advisor did not know how to explain, say, for example, how a dimensional active ETF fund works. And so it's become increasingly important to advisors, and they're demanding that, or investors rather, are demanding that their advisors know how these products work. And they're so flexible and wide ranging in their applications, whether you need income or you're investing for growth, or you want to target a sector or even a smaller subsector. I believe that investors should be screening advisors for whether they have knowledge of ETFs. And, to add to your point about the percentage of assets under management, I recall, and maybe Jeff can add to this, that I think most of these advisors had, well above 40%. Some of them had over 90% of their assets in ETFs. And I think this is a really important aspect for investors to know while they're screening their advisors. And this leaders list is a very good tool for that.
It's kind of interesting what you're saying, Ken, about finding advisors that are interested in ETFs or that are familiar with ETFs. I mean, this is where everything is headed. And we know that. We know that by the data that we look at. We see the money moving out of active and passive mutual funds and into active and passive or indexed ETFs. It's all moving in that direction. All the numbers point in that direction. And if an investor is looking for, I guess, investment and financial advice in the future, it's just going to lean toward ETFs. That's all there is to it. I mean, you can't really get around it unless something different comes along, and maybe we'll get to that in the future with the conversation with Rick Edelman, who is always looking at the future. But Kristen, can we talk a little bit about the kind of the evolution of this list? I mean, there's 100 names there for advisors, and there's 50 names there for firms. How is this being updated? How is it being, next year, is there going to be 100 more, or will there be some dropping and some adding? And how is that all going to happen?
That's a really great question. So yes, we are going to be doing this year after year, so everyone can make sure to continue to keep checking out the leaders list. Again, you can find it at etf.com/leaders. And so if you want to go check through the names that are on the list, or perhaps you're on the list and you just want to see your name on the site, make sure to go check out etf.com/leaders. Now, I will say we are planning to add to this list every single year. We will also be doing call outs of the leaders. And for those that are readers of our site, which I hope everyone listening to this podcast is, you'll be seeing a lot of these names as we, of course, tap the members of our leaders community for articles and for pieces of content that we have on the site. I mean, this is just a big community of advisors and clearly have expressed that they utilize ETFs in client portfolios, and they're definitely a community that we want to talk to. And then going forward, if you are a member of the leaders list, Look forward to content that is tailored to you, and look forward as well to engagement opportunities with other members of leaders and essentially ETF.com. So this list is truly just a starting point. It is, again, not really so much a list, but rather a community that we are really, really excited to grow with this 150 names, again, of both advisors and firms as just the start. So, yeah, this is really just the beginning part of this leaders community with the launch of this list. We're super excited to see how it's going to continue to grow and essentially be able to welcome all of these members of the leaders community truly into the ETF.com family. Again, if you are someone who is interested in joining the leaders community or you feel that you should be featured on this list, be sure to visit ETF.com/leaders so that you can make sure to be aware of all the events that we have coming for the leaders community, and also be sure that you're aware of when we're going to be opening up applications around this time next year for you to join the leaders community. All right, next up, we're going to be continuing Exchange Traded Fridays with a conversation with Alps ETF Chief Strategist Paul Bayaki. He'll be chatting with Sumit Roy and Ron Day on small cap ETFs. Be sure to stay tuned to Exchange Traded Fridays.
Thanks, Kristen. Great discussion there on leaders. Now we're going to switch gears and talk about small caps. This is a segment of the market that has taken off recently, and we have the perfect guest here to explain why that's happened. Paul Bayaki is the Chief ETF Strategist at Alps. Paul, great to have you on the show.
Great to be here, Sumit.
Absolutely. So, Paul, I want to talk to you about small caps and the recent performance we've seen. After Trump won the election, we saw something like a 6% gain in a single day in the Russell 2000. Why do you think the market reacted so positively to the results?
Yeah, it's a good question. We've seen small caps provide some head fakes during the calendar year 2024. If you look back to the summer, when we got lighter than expected inflation data, which the market read as instructive in terms of the beginning of Fed rate cuts, which we did eventually end up getting, you started to see these really violent rallies in small caps. And I think historically, declining interest rates, Fed easing cycles have been supportive of small caps. And so I think you have that expectation that we're going to continue to see Fed easing, and that should be beneficial for the small cap segment, which, as you know, is a segment that's fraught with a lot of risk. You've got a lack of profitability in many companies in the small cap universe, at least in the Russell 2000. You've got a lot of leverage. You've got a lot of floating rate leverage. And so that floating rate piece of the leverage profile, certainly the expectation is that it would benefit their funding costs to see meaningful easing from the Fed translating to a decline in interest rates. I would also say, as it relates to the election results specifically, if you think about some of the policy proposals of the Trump administration and maybe even a red sweep of the two houses of Congress, the expectation is that we're trying to reorient toward domestic means of production and supply chains. And small caps are very much domestically oriented. There's not a lot of multinationals in the small and mid cap universe. They tend to have a footprint in the domestic market. They don't have as much currency exposure. They certainly don't have, all else equal, as much geopolitical exposure. And so you add those two things up, and I think that helps explain the rally. You also, within the Russell 2000, have 9% of that index in regional banks. And you look at the regional banking stocks on the back of those election results, I believe they were up north of 10%. So a 9% slug in the Russell 2000, up 13%. That helps contribute to a 5+% move in the Russell 2000. But as is natural with violent moves like that, you've also seen the beginning of a drawdown off of that high, and we'll see how persistent that drawdown is. But that's the nature of small caps. You have these violent moves. It is a more volatile segment of the market relative to large caps. And we've already seen in calendar year 2024 two drawdowns in the Russell 2000 in excess of 8%. So it is a segment of the market that's fraught with risk, but when you look at the setup and why people have been making the case for small caps, certainly what we've talked about as it relates to small caps is first and foremost, the valuation spread between small and large is as wide as it's been going back to the dot-com era. So you've got the valuation story. Then you've got the cyclical story, which we touched on in terms of Fed easing cycles, inflation above 3 and falling, typically a nice setup for small caps. And then on the fundamental side, you've got some policy alignment potentially, but also earnings growth for the Russell 2000 and subsets of the Russell 2000 is expected to be in excess of the aggregate earnings growth for the S&P 500. So you add those three things up, and I think that's part of the reason why interest is bubbling back up in small caps and why we're seeing some strong relative performance in pockets.
Oh, this is Ron Day. IJR is up 38% over the past 52 weeks, which is a pretty good gain if you are an investor in small caps. Do you think this giant move is justified, or are there some potential weaknesses?
Well, I think when you think about IJR, it does have a smaller slice of the overall small cap universe, at least as defined by S&P, and there's some requirements to be in the S&P 600 that aren't necessary to be in the Russell 2000 in terms of profitability. And so if you look at the relative performance of small caps as measured by the S&P 600 or even the Russell 2000 over that period of time, it has been shockingly outperforming the S&P 500 over that period of time. I don't know that I'm in a position to make a call whether or not that's durable or whether that's reflective of the profitability profile and the actual results of the small cap universe and what investors should expect on a go forward basis. That's a big number in terms of a total return over a 1 year period. But I will say that there are characteristics within that universe, a subset of that universe that I think are really compelling. Most people, I think, look at small caps as the underclassmen for large caps, and they'll eventually graduate into the S&P 500. And we've made the case that not every small and mid cap company is destined to be a large cap company. They may have a total addressable market that just is smaller than what's available to a large cap company. And so there's a lot of companies that are just destined to be small and mid cap companies as long as they exist. And as long as those companies do certain things, we think they can provide a really compelling risk reward profile. What are those things? Well, do you generate profitability, not just in absolute terms, but relative to your asset base? Do you have leverage? Ideally, you're able to generate profits without excess leverage. And then I think one of the big signals in small caps historically has been, are you growing your dividend? Not only are you paying a dividend, but are you able to grow a dividend? And is that dividend well covered? And so I do think history tells us that when you get this type of delta between the valuation on large caps and the valuation on small caps, it's portended to strong relative performance for small caps. But I would also argue that this is a very different environment for small caps than they've experienced over, say, the past 10, 15 years, where interest rates were extremely low, inflation was extremely subdued outside of small periods of time. And now we're likely to be in a period where, although interest rates are likely to fall from their sort of near-term highs and inflation is decelerating relative to its all-time highs or near-term highs, the reality is that interest rates are likely to average a higher level than they've averaged over the past 10, 15 years, which isn't necessarily groundbreaking because we've effectively been in a period of zero interest rate policy. And we're also just likely to see inflation settle in at a higher level than it's averaged over that period of time. And that, to me, is a more punishing environment for small caps because they tend to have less scale than their large cap counterparts. Their ability to go out and borrow at certain rates is typically not as strong as their large cap counterparts. And so I do think that you get these violent moves, and that's the volatility commensurate with small and mid cap companies. But it's also important to know what matters over longer periods of time.
Yeah.
Paul, a lot of investors, they become somewhat disillusioned with small caps because of the performance versus large caps. We've seen SPY and other large cap ETFs outperform pretty significantly because of those mega cap tech stocks, which have been absolutely soaring. Do you see that dynamic changing where the small caps can start to outperform the SPYs of the world?
Yeah, so it's tough to make predictions on a relative performance basis, but I do point to this idea that history doesn't always repeat itself, but it often rhymes. And so what history is telling us is that historically, when you get that type of dispersion between large cap performance and small cap performance, which leads to a valuation spread like the one we're seeing, which is as wide as we've seen going back to the dot-com era, which preceded a strong period of relative performance for small caps relative to large caps. That does tend to be a good historical setup for small caps relative to large caps. But to your point, there is a powerhouse nature to those companies that are driving large cap returns. There is a profitability profile. If you look at the ROE on the tech sector, which is compounded at 30% over the course of the past 5 years, that's a very high quality profile in a market that's rewarded high quality. And so I do think that there is an opportunity. History tells us, you look at Fama and French, or you look at, modern portfolio theory, small caps are an important part of an asset allocation, and they're accretive in terms of the return and diversification. But I think it's always important to put it all in the context of where we are now. And I don't think necessarily that investors can just naively cap weight their small and mid cap portfolio and expect to have the same outcome that they might have had in prior periods. And the point I'm trying to push home, of course, is that you need to sort of reorient your small cap exposure toward the characteristics that we think are going to be rewarded in this cycle. Things like profitability, lack of leverage, dividend growth, and dividend coverage.
Well, what about rates? I mean, they could be a headwind to the group if they keep going up. I mean, that's a big thing to consider right now.
Yeah, I mean, you look at the Fed cutting 50 basis points in their first cut and then another 25 basis points at their next meeting. And what we've seen on the 10 years that rates have continued to back up. And we're now at, let's call it 450 basis points on the 10-year. And so that will be a headwind for a segment that, as we talked about earlier, has a lot of leverage, has a lot of floating rate leverage specifically. So every time interest rates go up, all else equal, their borrowing costs go up. And then you marry that, or you pair that with a distinct lack of profitability. Famously, 800 of the 2,000 companies in the Russell 2000 are unprofitable. And so I do think that even if rates start to come back in a little bit, they've backed up so much, maybe we come back in. The reality is that that's still a higher level than I think a lot of small cap companies are used to operating in. And if it is in fact the case that we average a higher level on the 10-year on sort of borrowing rates for the benchmarks that these floating rate notes that these companies use is higher than they're used to, that just makes the equation of profitability and of free cash flow and of shareholder returns much more challenging. So I would say yes.
Yeah, interesting.
So, Paul, you make a compelling case for small caps, especially the valuations versus large caps. How should investors think about getting exposure to this space? Because I know you mentioned it, and a lot of people talk about how the Russell 2000 is filled with a lot of unprofitable companies. Is there a better way to invest in small caps broadly?
Yeah, we think, and certainly it ties to our product, OUSM, which is our quality dividend mid cap strategy that gives you exposure to small caps along with some mid caps, is a better, more durable way to play the space long term. And what do I mean by that is one of the keys here is drawdown avoidance. So I mentioned that the Russell 2000 has already had 8% drawdowns, two of them here in calendar year 2024. That is additive from a volatility perspective to an asset allocation, and in some ways undermines your confidence in being able to allocate consistently to small and mid caps because of that volatility profile and the lack of profitability. And so our argument is just take that universe and cull it down to companies that generate profits, that don't have excess leverage, that grow a dividend and have dividends that are well covered. And if you look at the sort of return stream that translates to and the manifestation of that in the market, it leads to lower downside capture, shallower drawdowns over time. And although you're going to sacrifice some leverage leverage to those sort of rip your face off rallies like we saw last Wednesday in small caps, it also means you're going to avoid the worst outcomes in the small and mid cap universe. So at a high level, our argument is small and mid caps are important. The setup for them, at least from a historical playbook perspective, is potentially attractive, but we advocate against being too naive in your allocation there and moving off of beta towards something that's more representative of quality characteristics in a universe that is really devoid of quality when you think about the lack of profitability, the high amount of leverage, and the amount of floating rate debt in that universe. And of course, 9% of that index is in regional banks, the Russell 2000, that is. And regional banks aren't necessarily going to have all of their issues solved by 75 basis points or another 100 basis points of rate cuts, because what's ailed them is certainly a mismatch between what they've lent money at and what they're borrowing money at. But also, a lot of these regional banks have a tremendous amount of commercial real estate exposure. And if you look at the sort of maturity walls of commercial real estate, hundreds of billions of dollars year after year over the next 3 years, that's going to be a punishing environment for regional banks. And a quality framework naturally will avoid some of those regional banks that dominate a lot of the exposure in the small cap space.
Now, Paul, please give us a little bit of a little information on your lineup of small cap ETFs at Alps.
Yeah, so the one I mentioned, OUSM, is one of the best performing small cap ETFs in the category over the past 3 years. It's a product that, as I mentioned, screens the small and mid cap universe. So it starts with the 501st largest stock in the United States and stops at the 3,000th largest stock in the United States as its starting universe. It excludes energy, materials, and real estate by definition. And then with the remaining stocks in that universe, it goes about reorienting the weights of those companies toward high ROA, low net debt to EBITDA, 5-year dividend growth and dividend coverage, which ends up being 115, 120 name portfolio of small and mid cap companies that, as we talked about, have those quality characteristics that have been rewarded and ultimately have experienced shallower drawdowns over the course of this cycle. And you go back to even the COVID market and you saw this violent drawdown in everything, including small caps. You saw this sort of rip your face off rally out of that bottom, and all of the companies in the market, including some of the worst companies in the market in terms of characteristics and quality. And then in late 2021, those companies all began drawing down, and OUSM didn't rally as hard off of that bottom, but it also hasn't drawn down off of that top to the same degree as other companies coming out of 2021. And that compounded drawdown avoidance can be a powerful tool for investors who are maybe a little sheepish about being in small caps. They understand all of what we've talked about, the inherent risks, the inherent volatility of that segment, but understand also that it's a diversifier and it's accretive to total returns over time. And so you can sort of tiptoe into that universe without taking full risk. And the beta of the portfolio to the Russell 2000 and to the sort of benchmark is also subdued. So that sort of risk reward profile is really how we position OUSM as a small cap allocation for advisors who are looking for a different way to allocate to core other than, say, IJR or IWM or any of the sort of passive strategies.
Yeah, with a 35% gain over the past 52 weeks, I should note. So according to our data right here. Well, look, that's a really good place to leave things, Paul. We appreciate you sharing your time with us and talking to us about your lineup and some analysis on small caps.
Really enjoyed it. Thank you so much for the time.
Thanks to all our listeners for tuning in to Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or you want to share your thoughts, join the conversation with us on Twitter at ETFCOM. That's ETFCOM. Catch you next week.